Right, good morning to our wonderful audience and welcome to the seventh FundRock Hedge Fund webinar, where we keep you updated on developments and positioning of fund managers in the hedge fund world, and a world that is certainly getting a lot more attention of late. We look at various strategies, gathering more insight to benefit from investors, regardless of the typical market cycle. It's my absolute pleasure to welcome our moderator for the session this morning, Adam Bulkin from Edify Invest. Good morning, Adam. How are you?
Good morning, Eugene. Thank you very much for the opportunity to present. I'm well, and you?
Yeah, fantastic. Adam, again, thank you for your time this morning. Really great to have you on board. You represent Edify Invest, but you've got a long-standing career in the industry as well. We have had positions like head of fund manager selection and global portfolios. You also run a range of portfolios at Edify, and included in that range of solutions, you've got two hedge fund solutions. You've got a growth hedge fund solution and a defensive hedge fund solution. So maybe before you introduce the panel for this morning and the topics, can you maybe just briefly talk to your business and give the audience, a bit more info on those two hedge fund solutions, how they came about and what they offer for investors?
Thanks so much, Eugene. Yeah, Edify is a boutique DFM, discretionary fund manager, but we've specialized in alternatives and particularly hedge funds. The firm comes from a hedge fund perspective, or has managed hedge funds. Members have managed hedge funds themselves. And so we think that we have some deep operational experience and expertise in the instruments underlying hedge funds, how hedge funds really work in the real world, particularly in South Africa. And of course, I have some deep experience from my previous roles, as you kindly mentioned, in hedge funds and alternatives. So we think we have some particular experience in hedge funds, and the model portfolios that we manage for our clients include our stable and our growth model portfolios, which are multi-managed portfolios of hedge funds. The one targets a return of CPI plus 3 and has handsomely outperformed that with great risk characteristics. And we have another which is a growth model. I'm going to show you very, very little information about those, but they will come up in my small introduction to why South African hedge funds seem to be able to generate good performance versus US hedge funds, which I think hopefully will be an interesting topic for our audience. Thank you, Eugene.
Adam, the session is yours. I believe you've got a couple of slides as well. So maybe we can start with that. And if you can as well, maybe just give the audience also a sense of where they can find your solutions and who can all access it. Yeah.
We've Edify has a website, and very welcome to have a look at it and contact us at your leisure. The speakers for today, I'm going to speak a little bit first, but I'm then going to introduce David Bacher from Corion Capital, and he's going to talk about adventuring and traveling and how that relates to hedge funds. I'm very interested to hear about that. And then we have Andrew Hansen, who's talking from Protea Capital Management, and discussing a bit of the interesting tools that hedge funds and Protea in particular use to manage risk. And then finally, we have Steyn from Steyn Capital, and he's going to talk a little bit about emerging markets. So I think some different topics from normal, and hopefully ones that the audience will find interesting. Sharing my screen now, and hopefully you'll be able to see it. Is everything good?
Here we go. Got it.
Right. Thank you.
Thanks, Adam.
Thank you. I only have a few minutes. I'm going to quickly go through some of the slides. As I mentioned, One of the things that we found interesting, I don't need to mention that. One of the things that we found interesting is the difference between how South African hedge funds have performed versus US hedge funds. So we produced some slides here about what the world would call a balanced fund, or what the US would call a balanced fund, which in that world is a 60-40 portfolio, 60% S&P, 40% global bonds. And then which is actually the gold line over here over time. And then what we did is we took the average of returns of all hedge funds in the investments. Okay, so we didn't pick a particular type of strategy. Obviously, there's a very wide range of strategies within the US. You know, the South African market has much more constrained number of styles or types of strategies, but the US has a very wide range of types of strategies. But to be completely fair, we just took the average of all of those returns, assisted in our data by Steyn, who's actually speaking today. You can see that in the blue line, and you can see that over time, the return of the balanced portfolio, so a simple 60-40 portfolio, has significantly outperformed the returns of hedge funds in the US. From a risk-return perspective, if you look at it, a risk-return scatter plot, hedge funds overall have generated lower risk, but the scale is somewhat misleading here. The difference in volatility is around about 2%, but the return that one gives up over that period is significantly more than that. So overall, the conclusion is that within the US context, it's certainly not clear that hedge funds have added all that much value for the reduction in risk that they bring. Now, the interesting thing is looking at this from a South African perspective, and here we can see quite a difference. So the top green line there is the Edify Growth Hedge portfolio, the one Eugene kindly introduced, which is our model portfolio. The next one over here is the South African long-short retail hedge fund cumulative returns. Then comes the Edify Defensive Hedge portfolio, the South African market neutral, the peer group of South African market neutral hedge funds, and underlying that is the South African multi asset high equity returns, and finally the South African multi-asset low equity returns. So you can see that from this illustration that actually South African hedge funds, long short and market neutral, and our own solutions have significantly outperformed the long only peer groups over this period of time. And the interesting thing again is actually with lower risk. So here we see the South African multi-asset low equity return and risk, the South African multi-asset high equity return and risk, and there you can see the range of hedge funds. So the South African long short peer group has outperformed the South African balanced funds, and with less risk, our growth hedge portfolio much higher returns, but within the same risk bucket as balanced funds. But particularly in the low risk area, you can see that both the Edify Defensive Hedge and the broad peer group have significantly outperformed that long only peer group, and with less risk. So it's very interesting. It's obviously good to see that certainly in South Africa, that hedge funds empirically are actually showing value. They are generating higher returns, but with lower risk than their long only counterparts. While in the States, yes, hedge funds have reduced risk, which is great, but certainly at much lower return. So what is going on? Why do we see the advantages of of hedge funds in South Africa, much more than we see the advantages in the US. Now, what we did is we asked a number of South African hedge funds, many who have global exposure, like why do they think this phenomenon exists? Like, what do they see in the US market when they're trading in the US market, which is different to the South African market, which helps them in South Africa. So there's a couple of points, and I'm conscious of time, so I'm going to go over some of them quicker than others. But structurally, because hedge funds hold cash on margin, and that margin in South Africa, that cash in South Africa earns high returns, often high real returns, and that's an important part of how a hedge fund works. There's a structural advantage to South African hedge funds in terms of the starting base of the cash that they hold on margin and the return that they generate on that cash. It's very different to the States, where for many years the interest that you earned on your cash was zero or very close to zero, and so your starting point, or your base was considerably less. Then within South Africa, certainly managers seem to feel that there is less market efficiency in South Africa. They're able to find arbitrages, value arbitrages, corporate arbitrages, or other inefficiencies in the market, which are less, which have not been arbitraged away to the same extent as in the US. And I'll come to that in just a second in terms of number of hedge fund managers. Also in the US, there are fair disclosure regulations, which has made it more and more difficult for engagements with management teams of portfolio companies, of potential investments. In the US, you're not going to get a lot of information. The US companies have to be extremely reticent in terms of how much information they share. In South Africa, there's certainly not implying that there's any unfair information that's received by managers, but certainly there's more information that can be gleaned through engagements with management in South Africa than in the US. So that engagement with management, those interactions with management that fund managers in South Africa enjoy, does help them in terms of their analysis, which is slightly different from the States. Then finally, it's interesting to talk about barriers to entry. So there are over 10,000 hedge fund managers globally, more than half in the US, while in South Africa, there's probably around about 60 hedge fund managers. Now, obviously, so that comes to this issue of efficiency and efficiencies being arbitraged away. If there's a 5,000 very smart managers, trying to look at arbitrage opportunities in the US versus the number in South Africa compared to the long-only space, you are going to have some opportunities that open themselves up in South Africa, which you might not be able to access in the US. Also, we think that the barriers to entry in South Africa are actually more stringent. So those managers, those professionals who really back themselves, who have the skill and the knowledge, those are the ones that are able to or try to open hedge funds in South Africa. In the US, those barriers to entry are slightly less. So in South Africa, you have your FSCA licenses, which are required, which are not easy to come by for a Category 2A license. Your prime broking relationship for access is more difficult to establish. There's the overall industry base in hedge fund industry base in South Africa is smaller, so it's difficult to launch new funds. There's high admin costs compared to long-only funds. So for all of these reasons, the barriers to entry, and therefore which managers feel that they have the right to play, and in fact have the right to play in South Africa, is less, and we think that's another important aspect. Finally, on the long-only side, our retail hedge fund risk exposures are limited in terms of the retail hedge fund regulation to 200% max gross exposure. And one could argue that although that limits the amount of leverage that one can use, and leverage can be useful, it also has both saved hedge funds and hedge fund clients in South Africa, particularly in the retail space, from blow-ups. I'll make an example there. The famous LTCM, which blew up in the States, was reputedly 100 times levered. So 1,000%, 10,000% leverage. So massive leverage, which wouldn't be available into the South African market. I know I'm running short of time, so there's also some other factors concerning the number of stocks in our market, the ability of hedge funds in South Africa to get their minds around the number of companies and the drivers of those companies, which is quite different in the States, when with the number of stocks that you've got, the efficiencies and so forth. Finally, just an offsetting factor which many of our managers spoke about was just that thinking and positioning in the hedge fund world in South Africa does get crowded, can be dominated by fundamental accounting based analysis. As I mentioned, there are less strategies, so you don't have a wide range of strategies within equities. They're quite limited in terms of what South African hedge funds can access. But overall, we think that the universe for equity managers in South Africa, from the hedge fund perspective, gives one some advantages over our US counterparts. For fixed income managers, these types of advantages apply as well. We have essentially a very sophisticated fixed income and equity market with all of the important tools that one requires for a hedge fund industry in South Africa, a very sophisticated financial services industry. We can do all of the hedging that we need, all of the derivatives trading that we need, and yet it's a deep and liquid market, and yet because it's an emerging market, it also presents great opportunities to us in terms of efficiency, in terms of volatility. So our market is both liquid and volatile, and that gives fixed income managers on the hedge fund fixed managers many great opportunities to trade inefficiencies, to trade volatility, but with using sophisticated methods and using a deep and liquid fixed income tool. So we thought that was quite interesting and important to highlight, and gives us some insight as to why in South Africa we've seen hedge funds doing particularly well for retail clients. And we think that's set to continue. We don't think that those characteristics are going away, and we think that therefore the opportunity set, the setup in South Africa is actually more advantageous than in other markets. So yeah, that's what I had to present. I see a question coming through for me. If there is less market efficiency in SA, surely more active managers should be outperforming equivalent passive mandates. That's not happening. So the person who asked that question, I think that's a fair comment. And I think my comments regarding efficiency don't necessarily always apply. So two aspects. Firstly, I'm speaking specifically about hedge funds now. And the second point to that is arbitrage opportunities in hedge funds don't only relate to, and in fact do not relate to, trying to outperform a passive index and the efficiencies related to that. My point would be that there are arbitrage opportunities, for example, corporate arbitrage opportunities, or holding company versus underlying company opportunities, or opportunities where you can see that a particular sector, for example, the property sector at one stage, or particular companies, that their earnings are likely to decrease, and therefore you can short them. So I think my point about efficiency was more related to structural inefficiencies or other types of arbitrage opportunities that hedge funds can access, but which long-only managers don't necessarily aren't necessarily able to access. So I think your point is well made. That across the globe, South Africa included, active managers have struggled to outperform passive indices. That's just an empirical fact, and we see it over many time periods, and I would agree with that observation. But I think the efficiencies that I'm referring to, relate specifically to these opportunities, which are not necessarily just, is the portfolio of companies that long-only portfolio of companies that I've selected going to outperform the index. I hope that gives you some. I hope that's a satisfactory response and what I refer to in terms of efficiencies. Right, great. Thank you very much for hearing me out. It's my pleasure and honor to be joined now by David Bacher from Corion Capital, and he's going to talk about travel and hedge funds. Thank you very much, David.
Thank you, Adam. Yeah, you made the point that I'd like to understand what travel has to do with hedge funds. And at Corion, we stand for three things: simplicity, engagement, and agility. So, in terms of the investment landscape, we understand investing, it can be a little bit complicated. We like to tell a story and try and simplify it, because at the end of the day, our clients are those clients who need to understand strategies and what we're trying to do. So hopefully in our presentation, it will all come together. So, in terms of travel, I think the overwhelming majority of us love to travel, to explore new places, enjoy the journey, and arrive at our destination fulfilled. And investing is really no different. 24 years ago, Corion charted a journey to help guide our clients to what we thought was important, lower correlation, lower volatility, and hopefully better risk-adjusted return. So it's over 2.5 decades almost of investment experience in going on this journey, which has been, a great journey for our clients, and a journey that's had many cycles and volatilities. And we've learned through that, and we continue to learn. But ultimately, the risk-adjusted returns that we have delivered has hopefully met our clients' requirements and needs. And I think importantly, as with going on any long journey, it's essential to travel with those you trust, with professionals of skill, experience, and vision to guide your adventure ahead. And at Corion, we have a team which I think is, potentially in terms of experience in the hedge fund industry, rather unique. I've been investing and been responsible for client portfolios since 2001 in the hedge fund space. We've got Anthony Hall, who was the previous chief investment officer at Navari. They were and still a big hedge fund player in the industry. Simon Deploy's been at Corion for 17 years, managing hedge fund risk and understanding the hedge fund environment and designing risk systems. My colleague Gareth Montano has managed hedge funds since, I think, 2005. And Anastasia has been a portfolio manager of a hedge fund portfolio for a number of years. And it's not only those individuals, the key portfolio managers are backed with people who have that experience in investments, the qualifications, etc. So, we feel confident that the insights that we bring to a journey, an investment journey, it is quite unique in the South African industry. So once you've picked your touring squadron, the next thing when you're going in terms of a investment or journey is to probably pick the mode of transport you want to travel with. And there's various different ways to travel. You can go on the ETF bus. The ETF bus might be cheaper and comfortable, and you probably get there at the end. But there's very little tools you can do in terms of managing that bus or being on that bus. or you can elect an active manager, and they would argue the active managers have more skills, better drivers, more control, and a much more comfortable journey, and are able to react to market conditions more efficiently than the ETF bus. But ultimately, one can argue that they still drive on the same road. Or investors can select to travel with the right hedge fund pilot, which we think we obviously are. And the beauty of hedge funds is their ability to maneuver and not get stuck in the traffic, to adjust to market conditions quickly, to be nimble, to have a focus on absolute returns, less restrictions, more ability to fulfill those needs of lower correlation and protection on the downside. So, from the hedge fund perspective, we'd like to think that you have more tools, more ability to react to market conditions and to fly where you think you need to get to your destination and not be stuck in the traffic. And I think managers is a similar destination. You don't want to pick a manager or a city that will ruin your destination and your holiday. You'd like to have different places to visit. Make sure you research those places. Make sure that where you're going to is aligned with what you're trying to achieve. And there's climate, and I think climate in terms of travel can be related to cycles. Every investment strategy has different times where it will perform and underperform. There are different strategies and different places where you want to be at different times in the market. You don't want to get stuck in the prevailing headwinds and rather be with tailwinds. So understanding and having a team that understands where to invest in that cycle is very important, and where we at Corion think we add significant value. And I think that is, evidence. I mean, this is an example of two managers who are actually both fixed income managers, and they're both very good, but they do different things. And what they do is really largely dependent, obviously, on their skill, but also on the environment in which they invest. And whilst they both have done very well over the long term, they have gone through serious or significant different return payoff profiles. So understanding, which environment suits which managers is a key component in terms of building a portfolio. And I think what's really topical is hedge funds and their cost. Now, hedge funds are more expensive than certainly ETF or some active managers, but their ability to do certain things, they're limited on capacity, that does come at a cost. And just like when you're going on a travel, sometimes it's very important to have that insurance, because it might cost more now, but in terms of the protection and experience you'll have if something goes wrong, that's when that protection is very, very valuable. So in terms of the experience and the Corion, and we've tried to simplify how we think about investing, but what has been the experience of our investors. And as I said, we've got fast approaching 24 years of investment experience, and we have two funds that we offer: the Absolute and the Multi-Strategy Fund. The Absolute Fund was launched in November 2001. Its return target is to outperform cash and to target a cash +3 return profile, which since inception it has done. We've shown this versus the multi-asset income category, which is a higher benchmark to obviously cash, and also to the low equity portfolio, because the Corion Absolute portfolio is a multi-strategy portfolio. It does have low equity allocations, and you can see that journey, we think, is firstly very, very long, and certainly has lived up to what we've promised our clients. Return is one thing. What about risk? In terms of how we communicate the Absolute portfolio to our clients, we target cash +3 at less volatility than the bond market. The All Bond Index is probably about a third of the equity market, but our Corion Absolute portfolio has delivered half the returns, half the volatility when compared to the bond index. In terms of our multi-strategy portfolio, here, in terms of strategies, maybe the best comparison is a long-short portfolio, but we invest in a variety of strategies to help our clients understand what we're trying to achieve. We put a composite benchmark, which is 50% equities. Once again, we're very proud of that track record, and we've compared that to more of a CISA medium equity category in terms of a comparison to what our clients invest in. A very consistent and successful track record. And in terms of risk, we've outperformed by not taking excessive or more risks in those indices. So, Adam showed a risk and return plot, or in terms of how our portfolios have performed versus the category average. We're very proud of this track record. The absolute portfolio has outperformed those category averages with less risk, and that level of outperformance for that period of time through different market conditions is certainly something that we're very proud of, and our clients has been thankfully reap the benefits of these strategies and the way we apply our portfolio construction, our diversification, and the experienced team we've built to manage these portfolios. At Corion, we also understand the benefits of the advisor. Hedge funds are a little bit different. They're there for unique requirements. We need to be, just like you have a travel advisor, financial advisor is so important in terms of communicating what we're trying to achieve to the clients. It is a partnership, and their role is critical for that journey. So, that concludes my presentation. Half of it was just my voice, the other half matched with a bit of visuals. But ultimately, we think we built a portfolio that has weathered different market conditions, different economic landscapes, to very different periods. We think that our way we've approached the portfolio construction in terms of the skill set we built to manage these portfolios, the diversification of the strategies, the diversification of the managers, has all been tested, and thankfully we know that the journey, thankfully, the risk-adjusted returns have been there. We know the next 10 years things will change, new roads will need to be plotted, things will evolve, but we believe we've got the team to get our clients on a new journey, but ultimately getting to the same destination.
Great, Dave, and thank you. And sincere apologies again. You were flowing so nicely. It was enjoyable just watching you speak. So nothing was lost. Dave, we've got a question, and I think maybe speaking to the last couple of slides or the last few points that you were making, and you'd be interested in your view. The question is: is the hedge fund industry pushing CISA and the regulator to access retail hedge funds more widely in terms of Regulation 28 products, and living annuities and the like, where most investors have large assets and require better risk management solutions? Why is the regulator so slow and reticent? Maybe you have some views on that. I will say, look, within living annuities, one actually can have theoretically 100% of one's portfolio in hedge funds, provided one has the financial advisor has the license to advise on that, to give the category 1 advice on that. But Dave, maybe you have some perspectives on that, and where the regulator is with respect to hedge funds and reticence in the industry.
Yeah, I think it's a very good question, and it's something that is critical. So the industry has made significant progress. I think one of the leading regulatory environments in the world in terms of getting the actual hedge funds regulated, the checks and balances, the disclosure, the managers being regulated. It's been unbelievable. But the last thing that hasn't been ticked is that CISs investing into hedge fund CISs. And I think that's what the question was. And I think the whole industry recognizes that to be a problem. The industry am aware of has been engaging, to answer the question, the regulators for the last 4 years on this topic. There seems to be some stumbling block. The feedback that we've got is it's getting closer, but we've been hearing that for a number of years now. So I'm not quite sure why, if it's the FSCA or Treasury, hasn't taken that step yet, because it is not aligned to Reg 28 principles. And ultimately, the CIS regulations should be aligned to the Reg 28 regulations for CIS regulated compliant portfolio, Reg 28 compliant portfolios. So it's a bit of a mystery to us, to be honest. I don't have a great answer to it, but all I can assure you, the industry is aware of it and has been continually knocking on the door of the regulator on this topic.
Yeah, and from Edify's perspective, I mean, we would agree. You know, we can show long track records of actual realized performance, which seem to demonstrate, which do demonstrate that this is a real advantage, and we keep on banging this door, especially in things where you require high returns but low risk. Living annuities would be a great example, and we really believe that. Fortunately, you know, you can access them to a great extent within that product than you can in Reg 28 solutions. But yeah, we would agree with the general point of the speaker's question, and that was one of the reasons why I wanted to look at you know, what is it structurally about South Africa, the South African market, that has helped investors in the retail market to achieve good risk-adjusted returns, and hopefully we've eliminated some of those reasons. Thank you so much, David. We are out of time with you. I'm now going to turn to Edric Jansen from Protea, who's going to talk about perhaps some of the same topics and how Protea uses their tools to hedge against risk. Thank you very much, Edric. We look forward to hearing from you.
Thanks for the introduction, Adam. David, thanks for that. It's always nice to go on the Corion journeys. So I'm going to start by sharing my screen. So hi everyone. Thanks to FundRock and BCI for the opportunity. As Adam mentioned, I'm Edric from Protea Capital Management. And today I'm going to talk about how we are building resilient portfolios, the kind that participate meaningfully in up markets while we protect capital when things get tough. So on the agenda today, so a quick roadmap. First, what's unique about Protea? What is it that sets us apart? Our people, our process, and our fund offering. And then we'll look at the tools that we use to manage risk, which results in the protection we provide and how we reduce drawdowns when markets fall sharply. And then I'll close off with performance, so you can judge our approach for yourself. As we know, businesses and strategies don't run themselves. People do. Most of you will be familiar with Jean-Pierre Verstaert. He's our CEO and portfolio manager. He's done a few of these webinars before. And he leads the portfolio management and investment process. And he's assisted by Dr. Steyn, who maintains our financial models and turns data into decision-making signals. And Deborah Brennan keeps the machine humming operationally. And Cecile is our first line of client services. And that leaves me with the messenger for today. And as you can see, it's a pretty lean team. That's by design. But the team will be expanding soon, so watch the space for another team member joining us soon. Our investment process is definitely a unique process. It's the marriage of two disciplines, quants and fundamental research, which leads to a made-up word. You won't find it in the dictionary, quantamental investment process. On the qualitative side, we read obsessively, test management quality, map the competitive landscape, actively fight our own biases. And on the quant side, we model full financial statements, pull in from Bloomberg, and we've got proprietary algorithms to forecast each line item of these financials for a period of 4 years into the future. and we translate these forecasts into fair values, and we graph the price versus value. So this man and machine approach helps us to make the most optimal decisions, especially during times when narratives aren't backed by numbers and the numbers ignore reality, which happen from time to time. And I'm not going to delve too deep in the process. Obviously, there's time constraints, but we've covered our process in detail during a FundRock BCI webinar in August. So for anyone who's interested to learn more about it, because it is the engine room, please feel free to go to that website, the BCI Manager website, and navigate to August Hedge Fund webinar. So our fund offering is also quite unique. We follow one process, and effectively, conceptually, it's two portfolios packaged in 4 different funds, but we manage a South African portfolio and a global portfolio. And we give people the opportunity to invest in each according to their geographic preference. But if you combine those two, you get the worldwide flexible fund. And that is our flagship fund, and the fund that I'll demonstrate or use to demonstrate the following few slides. And we also have an international fund, which is a more aggressive version of our Protea Global Fund, for people who wants to invest in dollars, euros, or pounds. So the risk management isn't a slogan for us, it's a toolkit. And these tools include option strategies, futures, and specifically the shorting of individual shares. And at the heart of it all, our primary risk management tool is diversification. Rather than taking concentrated positions, we prefer to include a lot of smaller positions within the portfolios. So compared to other hedge funds, we will likely have a lot more positions. For instance, our South African fund has roughly 80 positions. Our Protea Global Fund has roughly 180 positions. So the two together in the Worldwide Flexible Fund will give you roughly 260 positions. So a lot of diversification, a lot of small positions. And that definitely, I think, makes our approach a little bit more unique. Here are some examples where the short book did its job for us. So I specifically put it the top 5 on the global side, names like Wirecard, Jumia, Lucid, and locally Ascendos, Verbosis, and PPC. This is over a 8-year period when the 2 RIFs were launched. And we're always on the lookout for companies that are frauds, fads, or failures. And it's also worth noting that you'll see that these shares fell in excess of 80% while we were short, but the contribution to performance mostly ranges between 1% to 3%, emphasizing our preference to put 1s and 2s on the board rather than trying to hit 4s and 6s. So the additional tools at our disposal. So before I talk to the slide, I think, you know, there's a lot of things that make us unique and make us different, and it's all good. But what people really want to see is the proof in the pudding. And did the engine room deliver the outcome that people really want? So the next few slides is an attempt to showcase what all of that tools and process and people have delivered. And these tools at our disposal allow us to create what's virtually impossible to achieve with traditionally equities or equity-focused unit trusts. So on this slide, we demonstrate how we managed to capture the upside while cushioning the downside over the last 9 years. So 9 years and 1 month, so 109 months. And in 62 of those months, it was positive. And a FTSE Developed World Index gave you roughly an average of 4% during this time, while our fund was up roughly 1.6%. And it seems like it's not a lot of upside, but then focus on the downside. In the bear months, 47 months was negative out of the 109. And on average, we were flat when the index was roughly 3%. I think this is really powerful, and we're comfortable to give up some of the upside if we can save so much on the downside. And we did the same against the all-share index. And here it's a similar picture. You can see we didn't capture all of the upside. Again, we're comfortable. This is just the average return during those bear months for the fund. But even better, on the downside, on average, when the index was 3% negative, we managed to deliver a positive outcome, which we're very pleased about. So this is really where the tools in our toolkit becomes outcomes you can feel in real money. And why does it matter? Because these smaller losses leads to faster recovery and better compounding and lower sequence risk for client portfolios. And that's ideally what you want. This is just looking at from a different angle. This is also zooming in only on the bearish months. Against the all-share index, the fund managed to deliver a positive return more than half of the time when the index was negative. And against the developed market index, the fund was positive almost 40% of the time. This is simply, again, not achievable with a traditional long-only equity fund, and not necessarily all hedge funds either. But this is what a good hedge fund manager tries to achieve, really protect on the downside when there are bumps in the road. And at the moment, as we know, the market has been running hard, things are going well, and people tend to think that this is going to continue forever. But the bumps in the road is inevitable, and we are really trying to give people a diverse part of their portfolio that doesn't just follow the equities. Then the 10 worst months. This is really one of my favorite slides. This is when things turned ugly. Over the last 9 years, this is the 10 worst months on the FTSE Developed World Index. And we tried to show what did the fund do during these 9 years. And as you can see, there's a clear cushion. The drawdowns are a lot shallower, and the fund was actually positive 4 out of the 10 months. We did the same against the all-share index, and again, similar outcome, a lot of downside protection, a lot of shallower drawdowns, and again, 3 of the times, it delivered a positive return when the market was down in excess of 4%. And then the last slide, zooming out further about the downside. The worst single month, the worst rolling year, the largest cumulative drawdown. Across all 3, the fund's downside has been a lot shallower than equity indices. And investors underestimate just how much the journey matters. Shallow drawdowns, it means less time getting back to even. It also protects investors against themselves. We all see equity funds over 25 years that's done exceptionally well, beaten the benchmark comfortably, but sometimes during the bad times, they had drawdowns in excess of 40%. And the harsh reality is that we get in our own way, and people tend to sell at the worst possible times. We've seen it over and over again. And if a good hedge fund manager can achieve an outcome where you don't have to experience a 20, 30, 40% drawdown, you protect investors from themselves, because we are our own worst enemies. So we managed to show just how we are able to protect on the downside, but at the end of the day, people want returns. We can put our money in the bank or under the mattress or in an income fund, and we'll have no drawdowns, but we want to participate on the upside. So how much of the upside did we have to give up? And as you can see, we didn't have to give up that much. The fund had managed to deliver double-digit returns over all periods presented, and in excess of 15% over the last 3 years. So in other words, and we've talked, David also referred to this, where the rubber meets the road is really the risk-adjusted returns, not just returns. It's what comes with the return. And again, very pleased with these outcomes. And as I mentioned earlier, in our fund offering, obviously the Worldwide Flexible Fund is our flagship fund, and the pink line represents that fund. But we also give the people an opportunity to invest either in South African Global, but the 50-50 combination is the dotted line. And here you can see just how similar the payoff profile is to that fund. So advisors or anyone who uses a list platform can access the combination that gives that payoff profile. And then one of the funds that it's probably our most unique offering is the Protea Global Fund. And it focuses on stocks listed on global developed markets only. And it's a great option for investors who want to diversify their offshore exposure specifically. There are not a lot of hedge funds in South Africa that focus only on offshore and only on developed markets. And as you can see, over the long term, since inception, it's managed to deliver double digits, but especially over the last 3 years, year to date as well, the fund has outperformed significantly. And again, it's a great diversifier. We don't want to move in line with markets. We're comfortable being different. So just highlighting this as a unique value offering. So if anything resonated with you of what I just said, you're welcome to reach out to us. The contact details are there. And you have 20 seconds to read the disclaimer, and you'll be tested at the end of this. Thank you very much, Adam.
Thank you, Edith. What I wanted to ask you is, can you pronounce the name of that short name there? There was a Danish.
I was wondering if I should mention it. No, the answer is no, and I'm not even going to try.
No, but thank you very much. Look, I think we don't have questions from the audience, but there was a very excellent question at the beginning of my presentation about efficiency, market efficiency, and how, are we seeing that efficiency in the South African market? And I think hopefully what your presentation has demonstrated is that it's not necessarily about beating the market when the market is up. It's about those risk mitigation tools, those other inefficiencies, those other arbitrage opportunities, and those other risk mitigation tools that hedge funds can use, as you've so well demonstrated, to produce these asymmetric returns, to capture a decent amount of the upside, but much less of the downside, and then generate that compound return over time. It helps investors stay invested. That eases the journey, which is what David was referring to. So thank you very much. I'd love to speak a bit more, but we're running against the clock here. So I'm going to move on to our next speaker. But thanks, Edric.
100%. Thanks, Adam.
Andre, we're very interested to hear about emerging markets. Obviously, very strong performance of the broad market over the year to date, but it's been a tough ride for a long time before that versus developed markets. So we're extremely interested to hear about your take on emerging markets and how Steyn has exploited this opportunity. So thank you very much.
Adam, good morning. Good morning to everyone. Thanks very much for the invite and the introduction, and also thanks to BCI and FundRock. I think the theme so far, what I've heard is, that hedge funds are a lot more heterogeneous, a lot more different, and I think in my presentation I'd like to go in a little bit more into the nitty-gritty of how we're different. And I think, of course, being different is good, because what you really want to do in order to outperform over the long haul as an investor is invest in a number of different assets that each have the potential to outperform, but don't have a lot of correlation with each other. That's really the free lunch in investing of diversification. A quick introduction of Steyn Capital Management. So I've been a hedge fund manager for the past quarter century on 3 different continents, and I set up this business in 2009. I'm supported by a team of 17 people, and we manage approximately just over 18 billion rand in South Africa, both hedge funds and long only, Pan-Africa, Global Frontier, and Global Emerging Markets. And we have 3 portfolio managers managing these 4 strategies. And I'm very pleased to say that we've been recognized for performance here. The Hedge News Africa Awards are basically the Oscars of the local hedge fund industry. And I'm pleased to say that we've been either nominated or won an award in 11 out of the 16 years, 16 full years since inception. But we want to talk a little bit more about, where we see opportunity in markets currently. And on the long side, we're bullish emerging markets. So this graph shows the performance of the emerging market index over the performance of the S&P index. And the interesting thing is you can see there certainly are periods, and multi-year periods of sharp emerging market outperformance relative to developed markets, and then vice versa. And the interesting thing here is that, as Adam alluded to, at the end of 2024, we were at the longest stretch of emerging market underperformance on record. And we were, almost at the Asian financial crisis low levels on a relative basis of performance. And so that to us was very, very interesting. And as a result, we started including some emerging market exposure within our South African hedge funds, both on the long side as well as on the short side. And I do think that there's still, much opportunity there. One of the biggest correlations to emerging market performance is a weak dollar. So weak dollar, stronger emerging market performance. And, we've certainly seen that in the year to date. And we think we're at the beginning stages of a multi-year run, and that's supported by investor positioning. People really don't have a lot of exposure to emerging markets, and also supported furthermore by valuations. Now, South Africa is an emerging market as well, right? But we're quite a small emerging market, and I think while we will see trickle down, we haven't seen it yet. So I do think it makes sense looking at some other global emerging markets as well. Also reduces your idiosyncratic risk that we have here in South Africa. Of course, you need a way to be able to do this, or said differently, you need a license to be able to invest in these markets. And for us, one of the licenses that we have is this proprietary high quality universe. So there are more than 40,000 companies listed in global, emerging, and frontier markets. And we're hard workers, but that's a little bit too much even for us. And so we spent the last 12 years going over each and every one of those 40,000 companies' business models and deciding which is a high quality business that goes into our proprietary universe and which is a low quality business that goes into our short selling universe. And that's left us with approximately 4,300 companies in this proprietary high quality universe that we then clean up, for the earnings, for high quality earnings, low quality earnings, hidden assets and hidden liabilities. And then we marry that to daily price variations. And that just gives us this wonderful idea generation engine, which I think really helps us to focus our time only where we should be focusing it. Because if we didn't have this, basically you'd be left to picking ideas off what brokers tell you, which is not a great way of going about things, or looking at index construction to generate ideas. And so I think, this process has generated a couple of very interesting ideas for us, and want to reflect on a couple of them. And the first one is Hanwha Aerospace, which is Korea's largest defense company, South Korea, obviously. And we noticed this on our screen at the beginning of 2023, when the stock was trading at about 8 times enterprise value EBITDA, which made it one of the cheapest defense companies globally. And as we delve further into this space, we realized that we're obviously, post the Russian invasion of Ukraine, Israel, Gaza, we are in a very, very different world. And at the time, defense spending was in nominal terms actually below the 1989 level. So we saw significant runway there. Invested in the stock, and it's actually up 1,000% over 2.5 years. We have been trimming it as it's gone up, but earnings is up 700%. So it's still a very undervalued business, very long run order books, and I think it's something that's very different, not something that you'll get in most other places. Continuing on with that theme, another idea that our stock identified was Group L'Occitane, obviously a maker of the L'Occitane lotions and potions. And this screened for us at approximately 9 times operating earnings. The interesting thing here was that the business had an approach from its majority shareholder to take it private. And that approach had fallen apart because of the lack of financing at the time. And that sent the share price down materially. We also noticed that the business had this very, very fast-growing brand, Sol, which essentially had this Brazilian bum cream brand. And that brand was being rolled out in more and more markets. And we used things like tracking social media interest, tracking various shopping networks, speaking to retailers and pharmacy chains around the world. And that basically built this model for us of consistent outperformance of that brand. Cosmetics, lotions and potions, they operated very, very high gross margin levels, 70% gross margins. So your sales growth is very, very important. And so we invested at about 19 Hong Kong dollar a share. And we held it for a couple of months until we got a takeover bid of $34 a share. So a very successful one for us. And then just briefly, I'll mention what is currently our largest position within our emerging market fund, Mandarin Oriental Hotels. You might be familiar with the hotel brand. The attraction for us and the hidden assets that our process uncovered was that, while the hotel business was very valuable, worth north of $1 billion, they also had a number of hotel properties that we thought was easily worth $2 billion. And then a very, very large development property, which was nearing the end of its development phase, which we also thought was worth $2 billion. And so here's where the very complicated hedge fund math comes in. We go, they have an asset worth 2 billion, hotel properties worth 2 billion, and a hotel management business worth $1 billion. So 2 plus 2 plus 1 is more than the market cap and the net debt of approximately 2 billion. So very, very complicated. This stock has done exceptionally well for us. Since this graphic on the right was actually done, it's done well for two reasons. One is that development property, they managed to sell about 40% of the property to Alibaba for $900 million, really underpinning our $2 billion valuation estimate. They managed to sell a couple of additional hotel properties, and then just this weekend they attracted a bid from their majority owner at a 40% premium to the then share price. So this was exactly one of our preferred kind of investments, where we have this high quality business, hidden assets, value not being recognized, plus capitalists. And we tend to make these things fairly big. So Mandarin was a 9.5% position for us. So that's on the long side. I think in addition to being known as good investors on the long side in South Africa and emerging markets, we're also very well known as short sellers, as fundamental short sellers. And that's potentially because my first job in hedge funds was being a short selling analyst. So that really still speaks to our approach and what we do. And I think the nice thing is it gives you a different payoff. When you're shorting a stock, you actually get the cash from that short, and you can either invest that into stocks, or you can leave it in cash and earn interest, as Adam alluded to earlier. So, over the course of our history, we've made about 32% on the short side. That doesn't sound like a lot, but it's insurance that actually pays you a little bit. And that's enabled us to carry long exposure, where we generate a lot of our returns, but it's also meant that we have downside protection and much lower correlation. A couple of short sell candidates. This one might be familiar to some of you. It's PopMart, which is the owner of the Labubu doll, and it's a stock that we've recently shorted. In fact, we recently actually increased our short as early as Monday, and it's quite topical because the company just reported absolutely blowout revenue results for the quarter, as we expected, because we could see that the Labubu craze really peaked in July. So this is for the September quarter, and we knew that the expectations were ahead even of those very, very strong results. And the stock's down about 10% this morning. That's just how the market works. It works. The market is an expectational engine that sort of thinks about, how might the forward results look. And so for us, the really interesting thing here is that off this incredible craze, people are still expecting the company to continue growing revenue, not just this year, but next year and into 2027 as well. And I can tell you that the craze peaked in July for two reasons. One is that we track the social media interactions, and we can see across every market that, since July, the interest has really, really declined. And we also do track the secondhand sale prices of these dolls, which is in some markets down 80%. And then the second reason is that my mother purchased the movie dolls for our kids, our girls, in July. So that definitely signifies a peak for you. I think this is a very interesting fad-driven short. Now, a fraud-driven short is Absolute Energy, which is a stock in Thailand that went from 100 billion rand market cap company to a 10 billion rand market cap company when the CEO and the CFO resigned and were accused of fraud. That apparently is not good for the stock price. But we noticed this company, because it was reporting lots and lots of earnings, but generating no cash flow. And the earnings were basically driven by these mark-to-model accounting. And that's exactly what Enron was doing. So the company had these long-term contracts on renewable energy, wind farms, photovoltaic plants. And essentially, they were playing games with the return assumptions over the next 20 years. And that boosts your earnings. Now, the problem is that if you're running a fraud, you always have a lot of fake cash that you have to hide somewhere. And for these guys, they were hiding it in investments. So they were claiming to make all sorts of investments. And actually, the smoking gun for us was when the company reported an investment of about 4.5 billion rand equivalent into the government bond of an unnamed country, which had a conversion feature. So if anyone can tell me what a government bond converts into, please contact me afterwards. I'd love to know. So also in Brazil, we were short Americanas, which was actually Brazil's biggest ever accounting scandal. They hit $4 billion off the books. Stock went down initially 95%, and the company has actually declared bankruptcy since. So that obviously, when we're doing these shorts across these markets, that offsets a lot of the risk that we're taking on the long side. So it really enables you to get that emerging market exposure without the gray hair. Similarly, Sunac was a short that we had in a Chinese property developer, which went down 90%. And in fact, China Evergrande was, before we launched the fund, was in our model short portfolio. Ended up going bankrupt before we launched, but all of the Chinese developers were doing exactly the same thing. So corporate governance in China is really quite terrible. Let's hope that doesn't get recorded. So I don't want to get sued saying that or have a visit from the CCP, but it is very, very hard finding a clean company in China to go long. And that goes for even some of the very biggest companies. But so Sunac, essentially the government asked the property developers to adhere to 3 bright red lines, which were financial metrics, debt to equity ratio and the like. And essentially what these property developers did is they just lied. They just gamed the system. They just took debt off the balance sheet. They were providing loans for first-time home buyers, sort of mezzanine loans. And all of this blew up quite spectacularly. We do also short in South Africa. Aspen's been a good short for us this year. It's actually, we did close it in the sort of the mid-90s, but it's a company. It's a highly aggressive business. It's a company that also has highly aggressive accounting, and I think that really showed us that the earnings were under a lot more pressure than the management team was generally betting on. So I think that's a nice walk around emerging markets, longs and shorts. We are very positive emerging markets, but we like the idea of putting in some shorts as well. Because we're hedge fund managers, we sort of walk around the office all day going, but what if we're wrong, right? And so we want to insulate investors in case our view is wrong. The emerging markets can be more, like South Africa, can be more volatile. So it's a good idea having, some hedges in there. the net result of everything we do is illustrated here, and it shows the performance of our longest running fund. Showing that blue line in the middle is the net performance after all fees, and we've compounded at approximately 17% on an annualized basis over 16 and a half years. But the performance really comes from generating lots of alpha on the long side. So that gray line at the top is the long book, and also generating lots of alpha on the short side. So that purple line at the bottom is the absolute performance of our short book. And so it's doing exactly what you want shorts to do. It's going down, right? So while it's going down, we're able to repurchase it cheaper, and we're earning some interest on the cash as well. And essentially, over that time frame, we've turned R1 million into 13.6 million rand. The JSE would have gotten you 8.5, so comfortably ahead. But very importantly, also at lower levels of volatility than the JSE, much lower levels of correlation, and really, I believe, being able to provide investors with something different, not just another long only equity fund. Adam, thank you very much.
That's amazing. We literally have 1 minute, and we have to let Eugene also speak. With a very quick question, Andre, do you prefer certain emerging market managers, considering the transparency hedge funds would require of company information needed to warrant inclusion and information advantage? And second one, which retail hedge funds would you suggest for retired monies and living annuities? I'm not sure if that's one for you to answer, Andre.
Well, mine, of course, Adam. I sort of only heard part of the first one. You were talking about the inefficiencies in emerging markets.
Yeah, do you prefer certain emerging markets, considering the transparency hedge funds would require of company information needed to?
So I think corporate governance is poor in China, it's poor in Turkey. In South Africa, we're actually quite lucky. Corporate governance is quite good. We do like markets like Brazil, the Philippines, Indonesia. We've got some exposure across Hong Kong as well. We really do try to be all over. I think one thing that we do try to do is we don't want to have too much exposure in China. It's clear to everyone that the US and China are not as friendly as they used to be. And I don't think you want a very large portfolio, a part of your portfolio, to be exposed to that China risk. So we tend to have quite a modest net exposure to China. One, because of that, and two, because we find a lot of shorts in China.
And having worked in a US hedge fund, Andre, and the reporting requirements that you have in terms of your positions in the US, if you're a US hedge fund, do you find that an advantage, i.e. you don't have to do that reporting in emerging markets, for example?
So it differs market by market. Luckily, most markets don't force you to report your shorts. That's only really in Europe where you have to do that, and typically only when you're short more than 0.5% of the company, which we tend not to do. Liquidity is much more important on the short side than on the long side because of the potential of short squeezes. So we tend to size our short positions much smaller, and you want to have the process do the work there, really. It's fun talking about these blow-ups, but typically they're on the short side, but typically they tend to be 1.5% to 2.5% positions.
We really are short of time. Very fascinating and really interesting examples, Andre. Thank you very much, and thank you very much to the FundRock BCI team, Eugene, Tanya, and Olga, for the opportunity, and to all my speakers. Eugene, I'm going to sign off. Thank you so much for the opportunity. I hope it's been as interesting for the audience as it has been for me.
Been very interesting for me indeed. Adam, thank you so much for moderating the session. There's been some very insightful information shared by the panelists as well. And Andre, if you listen very carefully, I think there was a lot of funny moments as well. So thank you very much for that. To David, Adam, Andre, and Edric, thank you very much for attending a session this morning. And to our audience out there, the FundRock Hedge Fund webinars to continue. the last Thursday of every month. So thank you very much for that. Quick reminder, next week, Wednesday, we've got a session on local equity, and we're going to have a panel discussion and see where we're going with local equity. Eric also made mention of the Boutique Manager's website. So on the website, under Boutiques on Wednesdays, you can find a link to all the hedge fund webinars we've had so far. The recording of this and all the presentations will be posted on that website as well. And obviously, you'll also receive the thank you email from Olga and the BCI team with all the necessary links. To the entire panel, thank you so much. Been very insightful as always, and wish you a blessed week further. Thank you so much.